Now I'd like to talk about the next self-employed secret, which is secret number 3, and that is on the financial analysis. The financial analysis, which is really just knowing how to read and understand your financial statement, is extremely important in every business. And I'm going to tell you why it is in particular. In all the years that I've been a CPA, in all the years I've helped literally over 2,000 or 3,000 businesses, from startups to acquisitions to whatever, I got to tell you that one of the main reasons that businesses fail, actually there's 2 main reasons why businesses fail. The first one is lack of good, accurate financial statements and a lack of knowledge on the part of the owner to understand, even if he gets a good financial statement, what he's looking at. And the second reason is undercapitalization. So there you go. Those are 2 of the biggest reasons why businesses fail today. Right now, I'm going to focus on just a financial statement and just go over a couple examples to you, explaining exactly why it's so important. Your financial statement is extremely important from the standpoint that you've got to do it anyway. Look, at the end of the year, you've got to file a tax return, right? So you've got to summarize your income and expenses, and you've got to have a balance sheet, right, which lists your assets and liabilities. And by the way, there are 2 parts to a financial statement. I have so many owners come in and say, well, here's my financial statement, and it's just an income statement. It shows the income and expenses. That's not a complete set of books. The complete financial statement are balance sheet and income statement. If you're not getting both of them, then you either ask your bookkeeper accountant that you want both, or you go find someone else that can do it for you. And the reason is this: when you have a complete set of financial statements, both the balance sheet and the income statement, it forces the person preparing those financial statements to balance your debits and credits, to balance your assets, liabilities, income, and expenses. And if they can't balance it, it becomes apparent when you look at the financial statement and you know there's a problem. So real easy, you can kind of judge the accuracy, and you can judge the capability of the person preparing those statements by looking at the total of your assets and seeing if that balances with your liabilities and equity. And if it doesn't, you either bring it to their attention or you go find somebody else. Once you get a good set of financial statements, once you get a good set of numbers, you need to look at some key numbers. And I'm going to tell you these numbers are important not only for your survival as a business owner, but these are the same kind of things that a bank is going to look at if you ever need business credit. It's the same thing I look at when I represent clients to see whether or not they should invest in someone else's business. And here they are. What is the debt to equity structure? In other words, if someone has $1 million in debt and $1 million in equity, you may say, okay, fine. They can go ahead and with that much equity, they can sustain themselves and they're not over leveraged. What do you do if someone has debt of 20 to 1? In other words, you have $20 million or $20,000 of debt for every $1,000 of equity. Does that make you a little scary? I can tell you this: Warren Buffett will never invest in that company. The very first thing Buffett looks at when he analyzes financial statements is how much debt have they got in their books. And if they're heavily leveraged, he says pass right now. He loves companies that have either 0 or a very low amount of debt. Make sense? We all know Warren Buffett's done pretty good analyzing financial statements and buying companies. A bank does the same thing. They want to see if you're over leveraged. Now I know some of you are probably have a smile on your face because we all know what happened in 2008 to the banks. Did you know that when the banks went under in 2008, Citicorp was leveraged 38 to 1? Bank America was leveraged 26 to 1? But yet when you come in for a loan, if you're leveraged by any more than 10 to 1, they turn you down for a loan. What does that tell you? The very people that are making decisions on your loans couldn't pass the test themselves. I know. Some of you laugh. Yeah, I laugh about that too. No wonder we had so much problems in 2008, huh? All right, let me get back on the financial statements here. Sorry, I digressed for a minute. But your financial statement, some of the key ratios is not only debt to equity, but also your working capital ratio. And your working capital ratio is your ratio of your current assets to your current liabilities. Typically, we like to see current assets to current liabilities of 2 to 1 or at least 1.5 to 1, okay? And that simply means that your liquid assets, which is cash, receivables, and inventory, or anything that turns into cash within 12 months, that those assets are greater than your liabilities, which are your accounts payable, your payroll taxes, your accrued payroll, things like that, okay? So that's another critical area. And make sure when you look at your financial statements, make sure your accountant is listing current assets and current liabilities, long-term assets and long-term liabilities. Those are extremely important for you to look at, all right? Another key ratio is the times interest earned. In other words, whatever the interest is on the loans that your business has, how many times interest are you making profits in order to cover that interest? Let me give you an example. If your interest expense on all your loans is $10,000 a year, but you're making $100,000 a year profit, your times interest earned is 10 times. So you're making 10 times the money you need to cover the interest on your debt. All right? Banks look at that ratio, you ought to look at it too. And that is just a security in knowing that you're not just barely making enough money to pay down your debt, but you're making substantially more than enough. So making your debt payments is not a problem. Is that a concern for the banks? What do you think? Of course it is. So they're going to look at that key ratio. All right? Another thing you need to look at in your financial statements is many times I find companies are using their lines of credit, which is supposed to be for current working capital needs, and they're using their current lines of credit for long-term acquisitions like fixed assets, for example, equipment, furniture, and fixtures. Try not to use your current line of credit in order to purchase long-term assets. Your current line of credit is to carry your receivables in your inventory. Your long-term assets like equipment, vehicles, things like that, you need to usually have a separate long-term, a term loan on that. Not a line of credit, but a term loan to fund and to finance your long-term assets, right? There's another example of matching your financing needs with the type of asset you're going to acquire, all right? So there's a couple of examples, and I hope everyone understands the significance of this, because your financial statement is kind of like a rudder in a boat. With it, you can steer your ship and steer your business. Without it, you're going to go whichever way the wind blows you. And that's kind of a scary feeling. And many people are there. Because eventually, it's going to blow you up against the rocks and you're going to sink. So avoid that problem. Be smart. Look at your financial statements. And if you need help understanding them, sit down with your CPA or whoever your advisor is and make sure that they explain them to you. And if they won't do it or they can't do it, we at the Hawes Institute can. We're here to help you, and we're here to make sure you succeed. And we're going to give you every chance you deserve to make sure you do. Thanks for listening.